Welcome back to our market coverage. Let us dive straight into the numbers. The SPY closed at 711.58, the QQQ at 661.57. The VIX, our fear gauge, dropped more than 5% to 17.73, a low for the year. But don't let that fool you. The 10-year Treasury yield sits at 4.39%. The dollar index tumbled to 98.46, a 3-year low. Meanwhile, spot gold surged to a record $4,649.20 an ounce. WTI crude fell 4% to $104.60. Bitcoin is at $76,310, down about 1.1%. What do these numbers tell us? This is a market that looks calm on the surface but is deeply fractured underneath. The VIX is low, but money isn't flowing into risky assets. It's flowing into gold and treasuries. The dollar is at a 3-year low. Gold is at an all-time high. That extreme divergence is a classic sign of a fragile balance. Beneath the low volatility, there is massive demand for safety. Our core call for today is that we are in a high-level consolidation with a defensive bias before the data release. We put that probability at 70%. Let us talk about the global money flow. During the Asian session, Chinese assets got a boost from the central bank's liquidity injection. That optimism looked promising. But once European and US trading began, the momentum was clearly interrupted. Money did not follow the Asian lead into equity markets. Instead, it rotated into gold and US treasuries. We estimate the probability of this defensive shift at 85%. Tonight's US GDP data will be the deciding factor. It will either send money back into risk assets or accelerate the flight to safety. On the macro front, the Fed's statement was dovish, which is supportive for markets. But traders are not fully buying it yet. Everyone is waiting for the GDP print at 8:30 p.m. to confirm the strength of the economy. The dollar index breaking below 100 is a major event. It is significantly bullish for commodities and non-US equities. The drop in crude oil has temporarily eased inflation anxiety. But gold's record high tells us the market is trading currency debasement, not commodity inflation. Geopolitical risk remains. Russia-Ukraine talks are stalled, providing a continued risk premium for gold and crude. For specific asset classes, we see US equities as range-bound with a weak bias. Money is leaving the dollar but not entering stocks. Smart money is cautious on current valuations. Tonight's GDP is the decisive variable. A strong print above 4.1% could reignite rate hike fears and hit tech stocks. A weak print would confirm recession worries. So before the data, there is simply no catalyst for a rally. For China A shares, domestic policy is the main driver. Liquidity is ample and a weaker dollar helps ease capital outflow pressure. The outlook is neutral to slightly positive. Bitcoin is showing clear signs of risk appetite cooling. It is consolidating around $76,000 on low volume. Money is pulling out. In commodities, gold has the strongest conviction. It benefits from both a weak dollar and safe haven demand. The logic is clean. Crude oil is caught between geopolitical support and OPEC production increase expectations. Uncertainty is high. The clear trade right now is long gold and short the dollar. This is the highest conviction macro trade in the market. Gold at a record, the dollar at a 3-year low. The logic is strong and we expect continuity. The second theme is positioning for tonight's GDP data. Money is building defensive positions. Before the release, the move is to reduce high-risk exposure and increase defensive assets. The key event is the US Q1 GDP final reading at 8:30 p.m. Eastern. The market expects 4.1%. If the number comes in significantly above 4.5%, expect the 10-year yield to spike, the dollar to find support, and gold and tech stocks to sell off. If the number is below 3.5%, recession fears will intensify. Yields and the dollar will fall further. Gold will get a stronger bid, but equities could decline on earnings concerns. There are two main risks. First, if GDP comes in right around the 4.0 to 4.2% range, the market may have no clear direction. The fragile balance continues and volatility strategies will fail. Second, a sudden geopolitical breakthrough. If Russia and Ukraine reach a substantive ceasefire, the risk premium in gold and crude could unwind very quickly. Money would rotate out of commodities and back into risk assets, causing a sharp reversal. Our strategy for today is hedging. The core idea is a relative value trade long gold and short the Nasdaq. Alternatively, hold a small long equity position and buy put options for protection. We do not recommend establishing new directional risk before the GDP release. The current window is appropriate for setting up hedges. After the data, wait for the first hour of clear direction before considering trend positions. Here are our verifiable predictions. 1. The SPY will close lower today than it opened. 2. The CSI 300 index will outperform the S&P 500 today. 3. Bitcoin will not break above $78,000 in the next 24 hours. 4. COMEX gold futures will settle above $4,620 today. 5. The VIX will close higher than 17.73 today. Our overall probability distribution is 20% up, 50% sideways, 30% down. The market is waiting for direction. Stay cautious and keep your hedges in place.